Most retirees think inflation is a slow leak, like a tiny hole in a tire. But what if it is a blowout at 65 miles per hour right when you stop working and your paycheck disappears? Here is the scary part. Two retirement plans can start with the exact same amount of money, same investments, same lifestyle, and one lasts forever while the other runs out early. The difference is not luck, it is the withdrawal strategy. And in a few minutes, I'm going to show you one simple mistake that quietly makes inflation feel twice as painful, plus the step-by-step fix that most people never learn until it's too late. Number 1. The inflation monster you cannot see. Inflation is why the same cart of groceries costs more over time. It's why your car insurance jumps. It's why your rent or property taxes creep up. And in retirement, inflation is extra dangerous because you are not getting automatic raises anymore. A simple example. Imagine you retire and spend $50,000 per year. If prices rise about 3% per year, that same lifestyle can cost roughly $67,000 in about 10 years, and it can be close to $90,000 in about 20 years. Your lifestyle did not change, the price tag did. So the real goal is not just to retire with a big number. The real goal is to build a withdrawal plan that can bend with inflation instead of breaking. Number 2, the biggest retirement withdrawal myth. Here is the myth. If you withdraw a fixed amount every year, you are being safe. It sounds calm and responsible. It's also risky. Why? Because your expenses are not fixed. Some are flexible, like travel and hobbies. Some are not, like housing, food, and medical costs. If you withdraw the same amount while prices rise, you slowly squeeze your life smaller. That's how retirees become afraid to turn on the heat or visit family.
The better approach is to separate expenses into two groups, your must-pays and your nice-to-haves. Then, your strategy protects the must-pays first and lets the nice-to-haves adjust when markets and inflation act up. Number 3, the real enemy is bad timing, not average returns. Most people focus on average stock market returns, but retirees should focus on something else, the order of returns. If the market drops early in retirement and you keep withdrawing the same amount, you can do permanent damage. This is called sequence risk. It is like taking too much blood from a person when they are already weak. Example. Two retirees both start with $1 million. Both average the same long-term return, but one gets a big market drop in year 1 and year 2. The other gets the drop in year 10 and year 11. The first person can run out of money years earlier, even with the same average return, because withdrawals during the early drop lock in losses. This matters for inflation too, because when prices rise, your spending wants to go up. If that happens during a market drop, the stress multiplies. Number 4, the simple two-step goal for inflation-proof withdrawals. To inflation-proof your plan, you need two things working together. Step 1, make sure your basic spending has stable income that can keep up with inflation, or at least reduce how much you must pull from your investments. Step 2, use a flexible withdrawal rule for the money you do pull from investments, so you are not blindly increasing withdrawals during bad markets. This is the core idea. Stable base, flexible top. Now let us build it. Number 5, build your retirement paycheck in buckets. Think in buckets, not one giant pile. Bucket 1 is your paycheck bucket. This covers basics for the next 1 to 3 years. It should be in safer places like cash or short-term high-quality bonds, so a stock market drop does not force you to sell stocks at the worst time.
Bucket 2 is your safety bucket. This covers spending for years 4 to 10, often a mix of bonds and conservative investments. Bucket 3 is your growth bucket. This is for year 10 and beyond. This bucket fights inflation. It usually holds a diversified mix of stocks because over long periods, stocks have historically had a better chance of outpacing inflation than cash. Example, if your basic spending from savings is $40,000 per year, you might keep $80,000 to $120,000 in bucket 1. That is 2 to 3 years of withdrawals.
When markets are down, you spend from bucket 1 instead of selling the growth bucket. This single change can lower the panic level in retirement by a lot. Number 6. Use the guardrails rule instead of a blind raise every year. Many people have heard of the 4% rule. It is a starting point, not a promise. The problem is how people use it. They withdraw, then raise spending every year no matter what. A better approach is a guardrails rule. Here is the beginner-friendly version. Step 1. Pick your starting withdrawal, like $40,000 from a $1 million portfolio. Step 2. Each year, check how your portfolio is doing. Step 3. If your portfolio is healthy and above your guardrail, you can give yourself an inflation raise or even a small bonus. Step 4. If your portfolio is struggling and below your guardrail, you pause the raise or cut a little temporarily. Example. If inflation jumps but the market is down, you do not automatically raise spending across the board. You protect essentials first, then trim extras like travel, gifts, or upgrades. When markets recover, you can restore those extras. This is how you stay in control. You do not let inflation bully you into selling investments at a bad time. Number 7. Protect your essentials with income that can rise. Inflation-proofing gets easier when your basics are covered by income sources that are steady. For many Americans, Social Security is a key piece because it has inflation adjustments. Timing matters a lot. A simple example, if you claim earlier, your monthly check is smaller for life. If you delay, your monthly check can be much bigger. That bigger check can reduce how much you need to withdraw from investments every year, which reduces sequence risk and helps you handle inflation. Another option some retirees consider is an annuity for part of their income, basically turning a chunk of savings into a monthly check. This is not for everyone. Fees and terms matter, but the idea is simple. If your basics are covered, your investments can be used more strategically, not desperately. The point is not to pick one perfect product. The point is to create a paycheck floor, so inflation does not push you into risky withdrawals. Number 8. Withdrawal order can save your plan from inflation pain. Where you withdraw from matters, not just how much. Many retirees have money in different types of accounts, like a regular taxable brokerage account, a traditional retirement account, and a Roth account. Each has different rules. The goal is to reduce forced withdrawals later and keep flexibility. A simple, general strategy many planners use is this. Step 1. Use taxable money for spending early when possible, especially if it helps your retirement accounts keep growing. Step 2. Plan traditional account withdrawals carefully because there are required minimum distributions later that can force bigger withdrawals. Step 3. Use Roth money strategically, often later or in years when you need extra cash without raising taxable income too much.
Example. Imagine you spend $60,000 this year. You might take $30,000 from taxable savings, $20,000 from a traditional account, and $10,000 from Roth. Next year, you can change it. That flexibility is powerful when inflation surprises you because you can choose the least painful place to pull from. This is not personal tax advice. It is a framework. The main idea is control. Inflation hurts the most when you have no control. Number 9. The inflation shock plan for the first 5 years. The first 5 years of retirement are the danger zone. That is when sequence risk can hit hardest. Here is a simple plan you can follow. Step 1. Before you retire, build 1 to 3 years of basic spending in your paycheck bucket. Step 2. In your first 2 years of retirement, keep withdrawals steady and avoid big lifestyle upgrades. Step 3. If markets are down, reduce optional spending and delay big purchases. Step 4. If markets are strong, refill your paycheck bucket by selling some gains from the growth bucket. Step 5. Rebalance once per year. That means if stocks did very well, you trim a little and refill safer buckets. If stocks did poorly, you do not sell them just to rebalance. You use the cash bucket and give stocks time. Example: if you planned a $12,000 travel year, but inflation spikes and the market drops, you can switch to a $3,000 local travel year. That one choice can protect tens of thousands of dollars over time because it avoids selling investments at the worst moment. This is not about living scared. It's about knowing when to be flexible. Number 10. A simple way to stress test your retirement plan. Most retirees do not fail because they never saved. They fail because they never tested. Here is a simple stress test you can do on paper. Step 1. Write your must-pay monthly expenses: housing, utilities, food, insurance, basic health care.
Step 2. Write your nice-to-have monthly expenses: travel, eating out, hobbies, gifts. Step 3. Assume inflation is higher than you want for a few years. Step 4. Assume the market drops early. Step 5. Ask one question: can my must-pays be covered without selling stocks at a discount? If the answer's no, you adjust. You build a larger paycheck bucket. You reduce fixed expenses. You work part-time for a year. You delay retirement a bit. You delay Social Security. You do anything that increases your flexibility. This is where many people feel relief, because once you have a plan for the ugly scenario, the normal scenario feels easy. Number 11. The one mistake that makes inflation feel twice as bad. Remember the promise from the beginning, the simple mistake. Here it is: retiring with fixed expenses that are too high. Inflation loves fixed expenses: a big mortgage payment, a car payment, subscriptions you forgot you had, a house that is expensive to maintain. When prices rise, fixed costs do not give you room to breathe. The fix is not to live miserably. The fix is to lower your fixed monthly baseline before you stop working, so your plan has room to move. Example: if you cut $500 per month in fixed costs before retirement, that is $6,000 per year. Over a 20-year retirement, that could be $120,000 of spending you do not need to fund, and that is before thinking about inflation. Lower fixed costs also mean you can pause raises during bad markets without feeling trapped. This is the most boring-sounding move that creates the most freedom. Number 12. Put it all together with a simple annual routine. Let us turn all of this into a simple once-a-year routine. Step 1. Update your spending. Separate must-pays and nice-to-haves. Step 2. Check your buckets. Do you still have 1 to 3 years of planned withdrawals in the paycheck bucket? Step 3. Check your withdrawal guardrails. If your portfolio is strong, give yourself an inflation raise. If it is weak, pause the raise and cut only the extras. Step 4. Rebalance and refill. When markets are up, refill the paycheck bucket from gains. When markets are down, spend from the paycheck bucket and let growth assets recover. Step 5. Review income. Look at Social Security timing, pensions, and any other steady income, and make sure your basics are covered. This routine is boring on purpose. Boring is good. Boring is what keeps your money working while inflation tries to steal your future. Number 13. The sticky price trap. Some costs do not rise smoothly. They jump and never come back down. Think insurance premiums, property taxes, and medical bills. That is why your retirement plan needs a buffer, not just a budget. Example: your homeowner insurance is $1,800 this year. Next year, it jumps to $2,700. Your groceries rise too. If you planned for neat little increases, you feel blindsided. The fix is simple. Add a yearly shock buffer, like 1 extra month of expenses, and only use it for these surprise jumps. If you do not use it, it rolls forward and builds protection. Number 14. The healthcare spike that hits like inflation on steroids.
Many retirees underestimate how fast healthcare costs can grow, especially later in life. Even if you are healthy today, the future can change quickly. Example: imagine your normal monthly medical spending is $300. Then you add new prescriptions, more checkups, or a specialist. Now it is $700 per month. That's not just inflation, that's a lifestyle cost shift. A practical step: build a separate healthcare bucket inside your plan. Treat it like a mini emergency fund for medical costs. It can be cash or short-term bonds. This prevents you from selling investments during a market dip just because a medical bill shows up.
Number 15. The pay raise you give yourself should be selective. Instead of raising everything with inflation, raise only the parts of your budget that actually got more expensive. Example: if groceries and utilities rose, increase those categories. But do you really need to raise your entertainment budget the same way? Maybe not. This keeps your total spending from ballooning. A simple way to do it: each year, pick 3 categories to adjust up and pick 1 category to adjust down or keep flat. That one decision can keep your plan stable for decades. Number 16. The retirement spending smile. Spending in retirement often follows a pattern. It can be higher early on, lower in the middle years, then higher again later, usually because of healthcare and support needs. Some people call it a retirement spending smile. Example: in the first 10 years, you travel more. Then you slow down in your 70s. Then medical costs rise in your 80s. If you plan as if spending is flat forever, you may over-worry early or under-prepare for later. The fix: plan in phases. Early retirement fund spending is allowed, but it should be flexible. Later life healthcare spending should be funded more carefully. This is inflation-proofing because it matches how real life actually behaves. Number 17. The part-time income bridge that protects your portfolio. You do not need a job forever. Sometimes 1 or 2 years of light income can protect your entire plan, especially if inflation is high or the market drops early. Example: if you earn $15,000 per year doing part-time work for 2 years, that could be $30,000 you did not withdraw from investments during a risky window. That can reduce damage from early market drops and keep your future withdrawals healthier. This is not about grinding. It's about buying time when inflation and markets are loud. Number 18. The dynamic withdrawal cap.
A powerful safety rule is a simple cap. Do not let your withdrawal grow beyond a limit in a bad year. Example: you withdrew $50,000 last year. Inflation is high and your instinct is to raise to $55,000, but the market is down. A dynamic cap might say, in a down market year, your increase is limited. Maybe you only go to $51,500 and you cut optional spending to cover the difference. This tiny rule can protect your portfolio from the double punch of high inflation and low markets. Number 19. The refill rule that keeps you calm. Buckets only work if you refill them with a rule, not vibes. Here's a simple refill rule. Only refill your paycheck bucket from your growth bucket after a good market year. Example: when stocks have a strong year, you sell some gains and refill your next 1 to 3 years of spending. When stocks have a weak year, you do not sell growth assets to refill. You spend from the paycheck bucket and wait. This helps you avoid selling low and makes inflation spikes feel less scary because you already have near-term spending set aside. Number 20. The Social Security Inflation Shield move. Even though Social Security can adjust with inflation, the size of your monthly check still matters a lot. A larger base check can be a stronger shield. Example: if delaying your start date increases your monthly check, that can reduce how much you need to pull from investments. Less pulling during inflation spikes can mean more money staying invested, which can help your portfolio recover and grow. The key idea is not perfection. The key idea is alignment. Make sure your plan uses Social Security as a stable base, not just an afterthought. Number 21. The home decision that can make or break inflation proofing.
Housing is often the biggest expense in retirement, and housing costs can rise in sneaky ways even if your home is paid off.
Example: repairs, insurance, property taxes, and utilities can climb. A new roof does not care about your withdrawal rate. A practical step: create a home maintenance sinking fund. Set aside a monthly amount just for the house. Even $200 per month becomes $2,400 per year. Over time, that fund can prevent one repair from forcing a big investment withdrawal at the wrong time. Number 22. The one-page retirement rulebook. When markets fall and inflation rises, stress makes people do messy things. So write your rules while you are calm. Your rulebook can be one page. Example rules: if the market is down, I pause raises. I cut travel first. I do not sell growth assets to fund basics. If the market is up, I refill the paycheck bucket. I rebalance once per year. I review expenses every January. This is not just planning, it is protecting your future self from panic. Number 23. The inflation-proof mindset shift. Inflation-proofing is not about winning, it's about staying in the game. The goal is to avoid big mistakes that are hard to undo. Example: a retiree who cuts small optional spending during a tough year often ends up with more freedom later. A retiree who refuses to adjust and keeps raising spending during bad markets can lock in losses and reduce future choices. Your plan should be strong but also flexible. That's what makes it last. Here's the best part. Inflation-proofing is not about predicting the economy. It's about building a plan that can handle surprises without panic. You create a paycheck floor, you use buckets, you follow guardrails, and you stay flexible on extras. That's how you keep your lifestyle strong, even when prices rise. Now I want to hear from you. What worries you more about retirement? Inflation, a market crash early in retirement, or running out of money later in life?